Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. I've actually been following his work for many, many years. He's been a professional trader for almost 40 years. He worked in the pits at COMEX, trading gold and silver and other commodities. He's also written books on trading, a book on the gold market and trading. He started as a broker at Lehman Brothers and Prudential Securities. He moved on to be a hedge fund manager. He started Weldon Financial in late 1997. Since then, he's been putting out a newsletter covering pretty much everything from macro, central banks, liquidity, stocks, bonds, and commodities. Greg Weldon, thank you for joining me.
Wow, man, I've done a lot of things. I've kind of done it all. Started from the very bottom and worked my way all to the very top. And yeah, 40 years, man. But I've seen a lot, so we have a lot to cover.
You've seen a ton of different cycles, and the cycles that we're seeing right now, the stuff we're seeing right now is just really, really rare. We're recording this interview on Thursday, April 25th, 2024. The US dollar index is at 105.58. The 10-year US Treasury yield, just in the last month or so, it's gone from 4.2% yield up to 4.7%. Looks like it's going to go higher. The gold price is also screaming higher. It's gone up almost $250 in the last month or so. It's over $2,300 at $2,331. I want to get your thoughts, though, on the macro situation right now, because a lot of people have expected the Fed to cut rates, but it looks like these other central banks are going to start cutting rates before the Fed. What are your views on the current macro situation with the Fed and other central banks?
Well, I think, first of all, you got to give a little context to this, because this really kind of dates back to when Powell took over. You go all the way back to 2018. And you really, to get the full story, to understand why Powell is taking the stance he's taking now. All right. And if you go back to 2018, Jerome Powell has told us everything he was going to do, and he's gone out and done it. He might be the most transparent central bank we've ever seen. And in 2018, the Fed did 11 different white papers, over 300 pages. I read every single page. I know there was only 5,200 downloads of this document, so I don't think a lot of people read them. But it was fascinating, because it was a discussion of the protocols around a new paradigm of policy, and how central banks, since 2008, have had this situation where what you might call the neutral policy rate. Well, let's define the neutral policy rate, because it's a heck of a lot lower than it used to be, given, the situation with debt and how much we have to do to stimulate growth when we have recessions now. All right, because this is exponential, and it's a 50-year trend since they took the dollar off the gold standard in 1971. So when you look at what they said, look, we're going to let inflation, we want inflation to be higher, and we don't. See, the worst thing is the debt deflation. They fear that more than anything. I wrote that in one of the books I wrote in 2006, was called, it is like this kind of monetary Armageddon. Debt deflation would be so devastating. With all the debt, it would create a depression, the likes of which you might not even be able to print money out of. Look at Argentina. It's kind of a forefront of that kind of trend, all right, in the macro sense. And when this came to 2018 and the Fed, they said, look, we want inflation to securely be 2% and above. And to make this happen, we are going to let inflation run as high as it can. And there's something in theory called tolerance bands. In other words, we're going to say, okay, we have a 2% inflation rate. We want it to be above 2%. Well, you want the average to be above 2%, because we want it to be sustainably at or near 2%. So what moving average do we use? We decided on an 8-year average, which was interesting, because that means you would have to get the average and the period of time that inflation would have to be higher to be longer, because it's been so low, inflation, for so long. So from that context, let's let inflation go as high as we want. We're not going to have a tolerance band. In other words, if it gets to 6, then we're going to get worried, and we might actually scale some policy back a little bit. So there's 8-year average. There's no tolerance bands. Inflation goes as high as it wants to go. We're going to let it just fly. And then, because Jerome Powell is a disciple of Paul Volcker, and when you listen to Jerome Powell, you can go back and take Volcker's speeches on Capitol Hill, and the words are virtually the same. And when you say, well, Powell says we can execute the Volcker playbook, and we can raise rates dramatically and bring inflation down. So this is where they're at now. They want to ensure, that inflation, kind of comes down, but also stays above 2. So it is really like trying to walk the tightrope across Niagara Falls. It's almost an impossible task that the Fed is faced here. In this case, it is the effort to get inflation back to 2%. And you could say that they're not going to succeed. And while they might get inflation down close to 2, that you're going to see it vacillate probably higher for a lot of reasons here. All right. A lot of this is base effect. A lot of it is energy. There's a lot going on. When you talk about some of the things that have been higher, they're sticky. They're not necessarily coming down. You only renew your rent theoretically once every year. So these are the kind of things that are going to stay on the higher end. Some of the commodities have come way down, but now they're coming back up a little bit, which is concerning the Fed. You look at base metals are breaking out. Look at copper. Within that context, they really want to stay this tight longer, because if inflation comes back up to 4 or above, with a policy rate of 5.25 to 5.5, they're barely restrictive. And if inflation, God forbid, came back to 5, they'd be neutral. Now, there's a lot you could talk about beyond that. Is it going to be okay to be neutral down the road if inflation starts to crimp the economy? You could also suggest that if inflation stays at 3, all right, 3.5, which I doubt for now, at least in the near term, that the Fed would have room to cut, because they're 200 plus basis points on a real Fed funds basis. That's punitively restrictive as opposed to sufficiently restrictive. So you try and tie all that in with what's going on with the Fed. And what we saw in the last year or so is that the market priced in 6 to 7 rate cuts in 2024. Which was ludicrous. The market ran up, and you have this whole Fed rate cut bubble. Then you throw in AI, all right, and the very select sector that this is going to, boost. And this is why you see the breadth in the market is so poor, really. And then you throw in even something like, people believe the consumer is quite strong here. I hear this on television all the day. It makes me have to change the channel. I mean, I can't even watch financial TV, except to get the headlines first thing in the morning for much more than 15 minutes when I listen to these people talk. Because it's like, if you say it, it's true. That's not really the way it works. You need to back it up with statistics. And when people say the consumer is strong, the statistics completely belie that thought process. All you got to do is take the retail sales, take the consumer discretionary sectors, apply the inflation adjustment, because retail sales doesn't take into account the price changes, and you're flat to negative for the last 16 months in retail sales. The consumer, when you take wages, all right, you take wages of, let's say it's 4 to 4.5%. And I love to, go through the numbers and kind of, destroy the statistics based on what people are trying to make them out to be. When you look at the wage gains, and there was a couple months ago, everyone's all excited because average hourly earnings was up big, and it was a 4.5% year over year rate. What they didn't know or didn't care to know was the fact that hours worked fell, and the weekly take home pay fell for the month, and it was actually below 3% year over year, which is below any inflation rate that you might want to apply to it. The point is, real wage growth is flat at best. There's no real growth in wages to account for the higher prices you're paying for stuff. And then you talk about savings. Savings lower now than it was in 2019. You blow through $6 trillion of savings. And then you kind of look at, credit cards. We know that credit cards have exploded. People are using credit cards, and it's the credit card companies that are reporting that consumers are so strong, which is really interesting to me. Consumers are borrowing the most money ever at the highest rate ever to borrow money. That doesn't bode well for the future when a lot of people are living on their credit cards, have no savings, and their wages are not going up. So how the consumer is strong when retail sales are flat to down in almost every discretionary category except online shopping and eating and drinking establishments? Every single one down year over year, and has been for months on an inflation-adjusted basis. So you have a polarized dynamic that the Fed's looking to deal with here. And I think the outcome, and this is a long answer for just the Fed because there's so much more to talk about macro, and we talk about debt in particular. But when you come back to the Fed, I think you are coming to the point where the Fed is going to realize, and the markets are going to realize, they have to acquiesce to generally higher rates of inflation. And I could see a case where they basically go to an inflation range target, like some central banks have, of something like 2 to 2.5, 2 to 3. And if you look at their dot plot for 2025, everything's right around 2.5. Inflation is 2.5. Fed funds is 2. I mean, it's kind of like equal in a sense that would suggest that the economy is not really even doing that well, which is probably going to be true. So I think that that's the next big play, is that when the Fed kind of does have to almost force to acquiesce to higher rates of inflation, because inflation doesn't come down. And I think that the Fed would like to see some disinflation in the equity market too, as part of ensuring, because that would help squelch some of the higher commodity prices we have right now. But to that degree, that's a dangerous game because it's almost a house of cards. And if you pull too many cards out, you know what happens. So again, the Fed's job, I wouldn't want for the life of me. But I think ultimately acquiescing to higher general rates of inflation, which will boost commodity prices and it will boost asset prices. So I think to get there, you probably need the stock market to come off. And I think that's the next phase.
Okay, you went through a lot here. Let me ask you some additional questions based on what you said. Do you think that the Fed is trapped then with a supply and demand issue in U.S. Treasuries based on the budget deficits that DC is running, and that there's a serious supply and demand issue with Treasuries? And what I mean by supply and demand is the budget deficits DC is running, spending from DC, and now the foreigners like China, Germany, Japan do not want to buy the Treasuries that they used to.
Yes. Yeah, I mean, I think that that's definitely a big part of this is they kind of feel like they're going to have issues with the bond market. And I mean, let's be honest. I mean, spending's out of control. The February budget numbers, they spent twice as much as they took in. I mean, that's insane. I just don't even understand how that happens. And they're just going to borrow another 100 billion here to support foreign wars. I mean, let the Ukraine borrow the money from us. I mean, let's lend it to them. We're going to give it to them. Why are we, the people, the public, paying for all these wars over there? To whatever extent, I don't want to get political about it, and certainly you want to support those that are under attack. But at the same time, the bigger picture kind of dynamic on that side of the world is changed. And this is one of the biggest things that I said at the beginning of this year that you could have said in the beginning of 2020, that one of the big shifts that's going to come is the U.S. will no longer want to be or be able to be the military police to the world. And I think that there's a kind of pulling in on this kind of thing too. But when you look at the debt and deficits, it's clearly out of control. It's gone parabolic. And to the degree that this means the supply of debt is huge, again, you're borrowing from the public, and the means of financing is borrowing from the public. So it really is kind of crazy when you look at it, when you're taking in new money for Social Security to pay the retiring people and their benefits, Social Security, taking in new investor money to pay old investors that are cashing out. What does that sound like? We all know what that is.
Charles
and in
Ponzi.
In that context, it puts the dollar really under the gun here going forward. But as it were with the Fed and how this all applies, absolutely, this is part of the equation of the Fed being forced to acquiesce to higher rates of inflation. It's the only way. I mean, you're going to print money. I said this, another thing I said in one of the books was when you're staring into a debt deflation abyss, officialdom will choose to reflate at any and all costs, no matter what. And that's where we're at. So they will continue to print money. This is the trend now. And bottom line, Jason, when you really talk about what is the most important thing that we can discuss here, is that the biggest trend is the debasement of the purchasing power of paper currencies everywhere on the planet. And that is the case for hard assets. And that is the case where the gold bugs all of a sudden get excited. And you see gold up by $320 since February, which is higher than the entire price of gold was when I started trading for it at COMEX. It was less than $300 an ounce. And we just had a rally in a period of 6 weeks that's equal to the entire price of gold was 30, 40 years ago, 50, 60, 80, 100 years ago, however long it was that I started this business. But, I think everything you just said, and I think particularly the deficits and the debt, which is not just U.S., it's global. And that makes this thing global, and that makes this inflation global. And that's not to say stocks won't rally. They will, because when you print money and devalue the currency, the stock market goes up. The best thing that happens for the U.S. stock market is when the dollar depreciates. It's a direct correlation. A higher dollar, bad for stocks. A lower dollar, good for stocks. It's that simple. And the problem with that is that the pace of growth in the stock market will not keep up with the debasement of the purchasing power of your money. And that's the biggest problem. And that's why investors have to change the narrative here on what they do. And that's a big issue going forward for a lot of people.
Well, also, let me add to that. So you're right about the currency debasement, generally good for stocks. However, on the other hand, you also have the rise in the 10-year U.S. Treasury yield, and you have a lot of consumer, small business, private sector credit is priced off the 10-year U.S. Treasury. So if the 10-year U.S. Treasury keeps rallying, let's say it goes to 5, I mean, that's going to cause a lot of problems for the consumer, small business, and the real economy.
No doubt. And you're right on. And again, this is a 40-year downtrend in interest rates and inflation that's been reversed. So you're going to have higher lows here. And I think you've seen them. And, right now, 493 is the key level on the 10-year. You get through there. I would add, by the way, that the numbers out of Germany this morning were very encouraging, as it were, for spending in the economy. And you're seeing some signs that, some of these economies are wanting to shrug off these rates. And all of a sudden, the German bond market is getting just whacked the last 2 days. And to me, that's a big deal because the thought process was the ECB would be, ahead of the Fed. And now that's starting to kind of shift away too. And all of a sudden, the DAX, which has been stellar performer, is wobbling. So, I think that generally speaking, this all plays into the same kind of narrative that the Fed acquiesces to higher rates of inflation, and that comes with it higher yields, generally speaking. And at some point, that is going to cause a problem for the consumer. Absolutely. And I think we're probably closer to that point. I would add that when you talk about the consumer, watching the XLY consumer discretionary ETF or the XRT, the retail S&P retail ETF, and some of the relationships between the consumer staples or between the stock market or between the bond market can be very interesting because it's a leader. You can't have a really kind of strong growth narrative that is driving stocks higher unless the consumer is part of that. And right now, the consumer is underperforming. The consumer is, in fact, breaking down on pretty much every metric relative to the stock market. And we have seen these particular relationships bottomed before the market did in 2009. It was a pre-warning sign in 2007. It peaks first, it bottoms first, it leads higher, it leads lower, and right now it is broken down and bidding to lead lower. And if that's the case, then you're going to have a consumer come under attack sooner rather than later, and that's not something people are priced for here in the broader market indexes.
Yeah, and you brought up how savings have drastically almost zero or negative, credit card debt spiking. The other part of that is mortgage payments. And now mortgage demand, I think, in the United States is at a 15-year low. The average mortgage payment, I think, in a lot of cities and metro areas for a lot of single family homes or townhouses or condos, it's over $6,000 a month. A lot of people aren't getting approved for a mortgage. And if they do, it would take up too much of their monthly discretionary income budgets.
Yeah, and you have some issues too if you look at the latest new home sales. If you want to look at strictly the stock market impact of this, the home builders have been on fire. They really have. And when the individual shares have skyrocketed or hitting new highs, and this is a function of we need more houses. We need more homes. We have a housing shortage in this country, and that's a big part of it too. So when you tie in the fact that, on some measures, the mortgage rate's back above 7, you saw the weekly numbers have been really crappy for quite some time. These indexes, the MBA indexes, the purchase index, and especially the refi index is like a 30-year low. How much rates would have to come down to allow most people to refinance their loan at advantageous, degree. That's really low compared to where you are now. You need big declines that are not going to happen anytime soon. And you have the whole, affordability issue around homes. But I find within this that the number of homes for sale not yet started and the sales of homes not yet started, the sales are way down. The homes for sale that are not yet started are up significantly, a multi-year high, in fact. And all of a sudden, the home builder shares are getting hit. So, and the XLRE, which is the retail ETF from the S&P 500 sectors, also broke down last week. And so you're starting to see kind of round 2 of the issues here in housing. And this could be really interesting too, as you're saying, to the affordability and the whole dynamic, let alone that you've had stuff like lumber prices come way down and copper had come way down at one point. Now these things are starting to break out to the upside again. So, man, I'll tell you what, it doesn't bode well for the economy, for final demand from households and consumers over the next 18 to 36 months. And I think that's an issue for the Fed.
Did you see the Wall Street Journal chart that they put out in the last 10 days with all these different central banks? It looks like the game plan for a lot of these central banks is to potentially start cutting rates or at least let inflation run hot above the government bond yields.
Yeah, and that's the way it's been. And I think that, if you're looking for places where that's not the case, it's some of the emerging markets, all right? And we haven't even talked about emerging markets because some of them had inflation that was really high. A case like Brazil, they raised rates to draconian levels, 11, 12%, say in the case of Brazil, for example. And inflation came way down, and now you're sitting on 800, 900, 1,000 basis points of real official policy rates. So these central banks have been able to aggressively cut. And in fact, it rallied some of those currencies, which kind of kept the emerging markets off the radar screen in the context of there are a lot of currencies that are getting just wasted, that are at record lows. I made a list. I think this was in the fourth quarter of last year. It was like 21 foreign currencies had made all-time record lows in 2023. And when you look at the case of stuff like Vietnam,
is that against the dollar? What are the currencies low against?
Against the dollar. Yeah, against the dollar. It made record lows against the dollar. And when you look at some of the currencies, it's interesting because a lot of them are linked to commodity producing countries. Vietnam, all right, the dong. When you talk about Angola and the kwanza, you talk about Nigeria and the naira. Then you start talking about Turkey and Argentina and all the places that we know where these currencies have just gotten wasted. And it's a lot of them. You say, well, look, take a place like Nigeria and Angola. And they got 4 million barrels a day of oil output capacity, and they're producing about 700,000 barrels. So it actually impacts the global markets in the sense that these currencies are gotten so wasted, they can't possibly fulfill their capacity to produce oil, and that leaves a shortage. And right now, the shortage could be filled by those two countries alone if they were producing their capacity, but they're not. So, these are things that are worth watching, and I think that this is interesting because it kind of leads you back to gold. All of this conversation, and I'm not a gold bug, even though I started on the Florida Commodities Exchange in the gold pit, back in the 80s. I'm an everything guy, and I want to watch everything, and I want to trade anything and everything from either side. I have no bias whatsoever. You can't in doing what I do as a CTA, registered 3, commodity trading advisor, runs managed accounts. So in that context, it kind of all comes back to gold. Why? Because gold is rallying against every paper currency on the planet right now. That's the sweet spot. That's the tipping point. That's the change. And that's why gold has gotten so hot. Plus the fact that, China is buying gold like crazy and has been for a while. Their numbers are off the charts. And that's a whole nother story. I mean, China, man, we could talk about China for 3 hours.
Well, the demand for gold is also from India, Japan. I think Japanese gold demand is the highest it's been in decades. Do you think then the gold price in all these other currencies is sniffing out these central bankers that are going to let inflation run hot? They may start cutting rates, but it's going to be what the game plan is yield curve control, where they let inflation run above the bond yields for years?
Yeah, absolutely. And that's a bullish scenario for gold. It really is. And that's the whole kind of macro picture of acquiescing to higher inflation, because you have no choice. You can't press too hard or you unleash a debt deflation, because the debt is onerous. Again, tipping points. We've reached extremes. When you look at a chart of US public debt, I mean, it's straight up and down now. The line just goes straight up. And parabolically now you have to print so much more money to get the same economic impact. It's just a simple mathematical fact. So to me, it's just, 40 years of math have just changed in the other direction. And this is a trend that probably lasts for the next 2 decades at least. And it's going to be vicious. And people are going to have to do other things to kind of protect their money than just being passively long the stock market.
And the other country that has a debt problem, and a lot of people have said on a percentage basis is even larger than the U.S., unless you count the unfunded liabilities for the U.S. immediately, is Japan. And I think we're starting to see finally the currency weakness that a lot of people in the Widowmaker trade have been predicting for decades.
The Widowmaker trade. Yeah, for decades. I've heard the Japanese story for decades. And finally, now what's interesting to me is the JGB is finally now really potentially breaking down here on a major long-term, multi-decade trend basis too. But I would throw in the fact that, yeah, it's Japan, and we know Japan, and Japan will be a litmus test. I think that the yen has probably gotten a little too far, and I think that Japan is a place where they could be raising rates, and there's a lot of inflation push there. So, Japan will be a test case. I mean, if the BOJ, kind of stays where they are and continues to insist on being easy because their policy is, in fact, stimulative, that's going to be really interesting. And you see how much gold is up against the Japanese yen. It's doubled like in the last, since like the 2020 low. I mean, imagine the debasement of the purchasing power of the currency in a place like that, or in a place like Turkey, or in a place like India. You mentioned India. Gold priced in India is through the roof. The Indian rupee is now like one of the most debased currencies out there on a short-term basis. So, when you look at these countries too, there's over 40 countries now that have a debt to GDP ratio exceeding 100%. I remember when there was 3. It was Greece, Libya, and Japan. Now there's over 40. 41, 42, 43, something like that. It's over 40. So again, it's global. It's a Japanese style thing that's going global. But in the case of Japan, yeah, it's interesting. And guess through all this, what do you see? You see the Nikkei making like it's reaching the highest level since the 1990s. All these things kind of track back. So I think that Japan will have opportunities from the trading side, like being short the JGBs.
Okay, so you're saying then that it makes sense that with a weaker currency that the stock market would price that in and it would start to make nominal highs. That's what you're saying?
100%. I mean, the correlation in Japan is even tighter than the US. A lower yen equals higher stock prices to some degree. And certainly when you're seeing what's happening now with the fact that inflation is back in the mix, that makes that correlation go back to how tight it was, back in the 80s and 90s.
And I've had conversations with some Japanese investors over the years, and they were into like American technology stocks and real estate and a lot of foreign investments, foreign technology stocks. They did not consider gold up until recently. So it's like a new phenomenon there where the gold demand for Japan is finally starting to come back after decades of where Japanese adults wouldn't even consider it.
You see actually a lot of that. I mean, a lot of people have missed this gold move. People got frustrated with gold at one point, and I get a lot of questions about gold all the time just because of my background. And it's interesting because, frankly, gold and the dollar have diverged in a way that we've never seen before. And on a gold adjusted value basis, the dollar is at a 12-year low right now. So that tells you a lot about what gold is doing in dollar terms that has been mind-blowing in the dissociation with the fact that the dollar is actually higher right now. So I think that a lot of that frustration was like, why isn't gold taking off? Why isn't gold taking off? It's not taking off because the dollar is not coming down, all right, on its own merits, nominally speaking, the dollar index. I think relative to the fact that dollar wasn't breaking down, gold was performing phenomenally, and you were going to get this thing, and I said this in the beginning of the year, gold's going to break out, and people are going to end up chasing it because they feel like they don't own enough. And you are right in that situation right now.
Well, last year,
and that makes gold a buy on this dip too. So,
well, last year, Greg, I mean, the gold price was range bound, right, in US dollars, but in every other currency it was at or near an all-time high. So people are like, is the dollar gold price ever going to break out? But like in the fiat currencies, the relative fiat currencies, the dollar was relatively strong relative to the other currencies, but the gold price was reflecting currency debasement in the other currencies first.
Yeah, and you knew it was going to spread to the U.S. I mean, for me, it was kind of an easy call. I mean, this is almost a slam dunk trade, frankly. It just required patience. And the fact that it's happening now, imagine where gold's going to go when they finally have to play the dollar card. I mean, holy mackerel. I mean, I've never said 3,000 gold. For me, it's always been a mathematical type of thing. And you look at it, I mean, 2,650 was our target for a breakout in gold above 2,000. I mean, gosh, you almost got there already. Imagine when the dollar breaks. Holy mackerel. I mean, you can't write off anything anymore. And this applies even to crypto too, frankly, when you start to talk about this, because you can, create a scenario where in a lot of these places, you talk about 40 countries that have debt to GDP above 100. You talk about all these currencies that are making new all-time lows against the dollar, and all the fact that gold's rallying all these currencies. Well, you can imagine a lot of these places where it's tough to get to the bullion dealer. It's tough to store your gold. It's tough to hold gold, right? And you really don't necessarily even want paper gold. That's maybe 2 steps away. But when you start to talk about what can these people do, got a phone, got a digital wallet, they can all buy some crypto, something like that. So, I'm like, I don't have a problem owning gold and Bitcoin. I don't see why people have to fight over this. I don't see why it has to be one or the other, why everything's binary now. It's ridiculous. So I think there's a case to be made for both. And it's kind of the same case.
Yeah, I agree. It's smart to have some diversification in this environment, some gold, some silver, some Bitcoin. Actually, you didn't bring it up, but the Indian silver demand, their imports for silver just hit an all-time high too in the last month. Absolutely insane, the number.
Yeah, because gold's now expensive. So yeah, this is the play in silver. When it's the lesser expensive one that gets the retail investors come in, and that could be the biggest pool of money at all. I mean, I remember when I was, when I was one of my friends, I went to Colgate University, and a guy who I went to Colgate with ended up running the bullion desk at Prudential. So he kind of got me in, and for a while I was the research provider for Prudential Securities for the metals, right? This was back in the late 90s. And we used to, I remember going into York, they were on the east side of Manhattan, the lower tip of Manhattan. And we would sit around on the bullion desk there after work, having a couple cocktails. And we would just talk about, just imagine if you get this percentage of money from the stock market comes into gold and so on and so forth, all these, pie in the sky thought process. And now you're there, 30 years later, here we are where it is that case where, oh my gosh, if you really see this thing where you don't believe the stock market and passive investing in equities, a paper asset here that is, dominated to whatever extent by the economy and by policy and by debt and all these things, maybe you just got to allocate some to gold. And I think that we really almost haven't even seen that start yet, frankly. The statistics really don't show it. I mean, ETFs, the value of gold held in ETFs is down. People liquidated their ETFs. People are not in gold to the degree that they were even, 3 years ago. So I think it's pretty explosive, and we've already seen the tip of the iceberg there.
Yeah, I agree. And there's also an underinvestment in commodities for a lot of metals on the supply side. So it's not like an oil and natural gas company that can drill a new well in, say, a couple months. They could have new supply online. Yeah. Mines take many, many years longer than that. So we could be looking at supply shortages in the future for a lot of key metals, whether it's copper, for a lot of electrification, artificial intelligence, electric vehicles, those types of things, and then silver going forward as well.
Absolutely. I mean, you're already seeing it. Copper is the first one to kind of go here. I mean, inventories are historically low. You've seen a big shift of the inventories that have gone to China, and that's not coming back into the market. So now all of a sudden, Western warehouse inventories are low. It's the same in some of these other metals too. You see all of a sudden aluminum is popped. Tin is always a leader. And, nickel, even after getting crushed in the whole debacle with the LME, which just destroyed their credibility as a medium of, trading exchange. You have a real situation with some of these metals and food commodities too. You've already seen what happened in cocoa. We're seeing it now starting coffee. All right. We haven't talked about El Nino, which is now already potentially flipping back to El Nino really quick, and it doesn't usually happen that way. These are weather phenomenon that are caused by big picture science that is happening on the grandest scale that is only going to intensify. So when you start to talk about risk, because if one of the things we're tasked to do is risk assessment, one of the biggest risk assessments is the actual environment, and not from the context of green, clean energy. I'm talking natural disasters, earthquakes, these powerful storms we're having. Yes, the rising of sea levels, all these things are linked to science that has nothing to do with human beings on this planet. It's really a fraudulent narrative to suggest that we are the cause of what's happening here. That's about as egocentric as thinking the earth is the center of the universe, which used to be a commonly held thought, right? So when you look at these things and you see the weather patterns and you saw the El Nino coming, I mean, we were all over this move in cocoa. Why? Because it's right in the firing line of some of the worst weather that come from El Nino. And you're seeing this in terms of a lot of food commodities. Then you start to talk about supply chains and stuff like this and food supplies, the commodities themselves. And this is why I think that people, not to be unhumble, and I hate to be salesman, I never do this, but to the degree that people that do what I do, that are commodity trading advisors that operate in the futures market, I have access to all these commodities, every one of them. Click of the button, I'm in. All the bond markets, all the currencies, all the metals, all the energies. I can trade them all, long or short. And that is going to be a phenomenal advantage going forward, because you're going to need to do these kinds of things to keep pace with the debasement of the purchasing power of your money. And one of those ways is going to be involved in these commodities like cocoa, like coffee, eventually soybeans. All of these commodities. You said the metals. Energy will be back too. I mean, it's kind of, to me, a longer term secular bull market that is about ready to go into the next upwave, in my opinion, let alone the risk that extends from the Middle East, that people are just incredibly complacent about all the risk, whether it's China, the political situation here, immigration, a hot summer, people don't have air conditioning. You could have social unrest, through the roof here in the U.S. this summer. So all of these risk factors that we don't really, that I consider, that I talk about, that I take into account, just seem the complacency around some of these things to me is really short-sighted and mind-blowing.
I actually wanted to ask you about agriculture and soft commodities, since you have covered that. I watched your videos and listened to your interviews for years and done an excellent job covering those. With the higher prices of these soft commodities, agriculture, do you think that the farmers are going to eventually have to order fertilizer and plant more? Or are we looking at like crop yield failures, food shortages for years? What's your view on this? Are farmers actually going to spend the money to buy the fertilizer and plant more crops and solve this problem?
Well, that's a great question. And I think it's the latter answer because, you could talk about in the U.S. all you want, but the U.S. really doesn't produce cocoa or much coffee. We don't grow that kind of thing. Certainly, the U.S. is huge. I mean, I'm not trying to minimize the U.S. role in all of this. My point is, when you talk about the affordability of maintaining your crop, that is already part of the problem. Why? Let's take cocoa, for example. All right, Ghana. All right, their currency, the cedi, has gotten annihilated. So they can't afford to buy fertilizer. They can't afford to maintain the crop and the trees and all the things that are involved in growing some of these crops, the fields, whatever it might be with each individual crop. So yeah, I think it is shortages. I think it is more intense weather that causes shortages, and then you throw in the fact that these currencies have gotten crushed. Decrease the ability of farmers around the world to maintain their fields and their crops on a longer term secular basis is huge. And I think the weather then plays into that as something that is absolutely more volatile and going to be in the extremes. It's not that it's hotter on record. It's also colder on record. There's record everything. It's polarized. It's both. It's not one or the other. It's all of them. And from that perspective, I think it is the latter. You will be facing shortages. You will be facing issues around a lot of these agricultural commodities that are not at all linked to monetary policy, that have much more to do with currencies, the things you said, and then the weather.
Yeah, because we have a huge divergence. I don't know if you've seen this between DBA, the agriculture commodities ETF that has like the futures contracts in there for like corn and wheat and soybeans, some of the other soft commodity futures contracts versus the the agriculture commodity producers companies like John Deere and
Sure.
Caterpillar and the other some of the crop growers like Bunge and some of the other food manufacturers, which is I think Moo. So there's an enormous divergence between the DBA, the agriculture ETF, and the commodities producers ETF.
Jason, that's a great point, and I think that goes right to the heart of what I'm talking about. Because being passively invested in those stocks, what's that got on you? Not you're not keeping pace. All right. What keeps pace is being in the underlying commodities, and that is not something that most people do. It's a lot of people don't know how to do it. I mean, futures markets are tough, man, because it takes capital. I mean, most people, you can't come into the futures market with 50 grand and think you're going to be successful. Not these days. These contracts now, say like gold. I mean, the contract is 100 ounces. This is a $250,000 contract. You buy one gold contract, you want $250,000 of gold. You want to try and do that with $50,000? I mean, you could be wiped out so fast, it's not even funny. So the risk reward is there. You could definitely make a lot of money. There's no doubt. I mean, you've seen people take 10,000 and make it into $1 million. The risk of ruin is very high in that kind of situation. And I think the biggest mistake that commodities futures traders that are kind of on the retail level make is being undercapitalized and not understanding the math. We did a boot camp on the futures markets back in 2018 or 19. It was pretty successful. We got a lot of attendance. And it was just a lot of it was teaching people the math around how to manage the risk and this kind of thing. So I think, again, it kind of gets back to, not to be self-serving, but anyone that does what I do, not just me, there's a lot of good CTAs out there, a lot of people with a lot of experience are going to be more valuable in the future, because people are going to really, if they really want to keep pace, these are the things you're going to have to take into consideration and take some higher risk to try and keep pace, because it doesn't come without risk. It's risky. There's no doubt. I can't say that there's no risk in this. There's always risk. But, I've been doing this a long time. We manage the risk very well. We're low risk traders. But I think this is something people need to be more involved in.
So for commodities risk reward right now, platinum group metals, so platinum and palladium. I mean, normally the platinum to gold ratio, platinum is normally above gold, at least historically. Now it's way below the gold price. Do you think that we're going to see some type of rally here? Or do you think that platinum and palladium prices, they're kind of cheap and hated right now? Are we going to stay lower than gold for a long time?
Man, you hit a sore point with me. I keep thinking platinum's going to, kind of be a buy here at some point when it's $1,300 discount to gold. All right. But there's a reason it's a $1,300 discount to gold. Platinum is kind of in a supply side surplus situation to whatever degree. Sometimes it moves into a very minor deficit on a rolling 12-month basis. It just doesn't seem to be there. I mean, I've actually kind of given up on watching platinum, which almost means it's about to happen. So I don't know, but I don't know. I do know this. If you get above, say, 11, really kind of 1050 in the forward platinum contract, I'll be a buyer. I will participate if this thing's going to be real, but I'm going to let it prove itself to me. I don't, I'm not one that's necessarily going to say, look, I got to buy it when it's at its cheapest. They say buy low, sell high. I like one of the old other cliches, which is buy high, sell higher. Right. In some cases, like platinum, I want the market to prove itself to me. I want it to break out first, and then I will buy it. And even though the risk might be a little higher then, and maybe I can't buy quite as much as I could have if I had, taken a bigger risk by buying it lower. It's just I want, in a case like platinum, it's been a non-starter. It's had several false breakouts. I do believe there's value there at some point, but I think that particular sector, along with some other places, may actually need the Fed to act, not more than just talk about acting or be perceived to be about to act. So I don't know.
Isn't there developing, sorry to interrupt you, isn't there developing supply side problems for platinum, because a lot of the supply is either from Russia, Zimbabwe, South Africa, and didn't the London Metals Exchange just put some restrictions? I don't think they're going to buy any metal from Russia, so I don't know where they're going to get the platinum supply from.
Well, you saw a big jump in some of the base metals on that, and platinum didn't get much play. I would say South Africa is definitely a place. If you start to see specifically with electricity in South Africa, it always seems to be kind of an issue that could be potentially a risk factor for platinum. So, but again, hey, if platinum's going to be real, it's got to get through 1050. If it gets through 1050, I'll be interested. Until then, I'm not interested.
Yeah, what I've heard from people who are saying that the reason it hasn't done anything, a lot of people are worried that there's not going to be the demand because of electric vehicles. But I think the electric vehicle companies are in the process of going bankrupt. And then you have the companies that make the hybrid cars like Toyota, and you still need catalytic converters. So if the car market changes, I mean, there's still going to be platinum and palladium demand for catalytic converters from hybrids and not electric vehicles.
Well, it's one of the reasons I've actually been watching palladium as potentially the one you want to buy, because palladium now is at a very, favorable spread to platinum as well. So it's at a favorable spread to silver, for example, palladium. Palladium's cheap, relatively speaking. And yes, it has those properties where if you were to see some kind of shift like that, palladium could come into quick demand. I remember back in the 80s when they started talking about cold fusion, and palladium went from being $150 an ounce to $1,500. I mean, it was wild. I mean, that was one of the most amazing moves I had ever seen early in my career in the 80s. So, yeah, I would probably prefer to keep an eye on palladium, even than platinum. The problem with palladium, it's a thinner market, tougher to trade, a little more slippage, kind of the things you got to consider too are the depths of some of these markets. Love to be more active in some of the markets like lumber or rubber or palladium. But, you have to see the volume come into those markets before you can become too involved. So there are some other issues behind just, okay, we're bullish on that, but then executing that, certainly in the underlying commodities, there are some limitations in some of these places.
Yeah, there's also not a lot of options for retail investors. They could try to buy the mining companies, but the mining companies for platinum and palladium miners in South Africa, a lot of them are close to bankruptcy because they have higher electricity prices and higher costs and lower metals prices. So their profit margins are being destroyed right now.
Yeah, and they are. But I'll tell you what, if platinum's going to rally, and that might give them some vig, then you're talking, these are pretty low prices for some of those, when you talk about Impala or some of the stocks you're talking about in South Africa, man, they have been decimated. All right. Even like, what is it? Stillwater, to the old Stillwater here in the US. When you talk about these stocks have just gotten crushed, these could be stocks that you buy and look at them as like an option on platinum and palladium. And it's like, you buy the stock, in the case of the old Stillwater, I think it's like around $5, a share. Last I looked, $4 or $5, somewhere in $4.50. And if that's the case, well, hey, you're buying a call option, all right, that has no time decay, that has, no real strike price other than the money you bought. Here's your premium, but it's not going to be subject to time decay, and there's no timeline value on when your option expires. So I think that, you could look at some of these things. We had some thoughts on that in the silver mining shares, very similar back in 2020. And, that, still kind of looking to work out. And some of those have worked out very well, actually, in silver, that have performed quite well. And one of them even got taken over at a much higher price. So sometimes you got to look at some of those things in a little bit of a different way. I hear what you're saying, and I totally agree with you. On the other hand, I think some of those PGM stocks, particularly those in South Africa, have gotten so whacked that you could buy them as a call option at this point in time and just put it in your back pocket and be willing to risk every dime you put into it like you would an option.
I think actually there's a large mining companies that are looking at that. So you're right. If the cycle does turn, there's hundreds of percent upside there for the mining shares. I think BHP Billiton was looking at Anglo American, who has a large amount of platinum and palladium mines
Yep.
recently. There's rumors of a takeover now.
Yeah, and I'll tell you what, that is another big story in the mining shares across the precious metals as well. So this has always been one of those things where you see even like a Newmont and a Barrick have really underperformed. And part of this is some of the debt they took on to buy more properties. And when you start to talk about even having gold in the ground that is not even yet being mined, that is owned by somebody's like a Newmont that took over a company that owned this property, was never going to be able to take that gold out of the ground. Well, then you start to see those stocks start to play catch up, because that is value there at some point where the gold in the ground becomes more valuable too, even before it's mined to whatever extent. So that plays with some of the potential merger and acquisition dynamics that you could see coming in the precious metals mining shares.
Well, I think for risk and reward, a lot of these gold stocks, gold royalty, gold miners are some of the best right now, because the gold miners are not pricing in 2,300 gold yet, because the Q2 earnings numbers are when we're going to actually see the 2,300 gold that we've been talking about for the last 20 or 30 minutes. We're going to actually see that hit with the profit margins and the free cash flow.
Yeah, and you see here with this decline in gold, the GDX and even the SIL have held up pretty well. I mean, they're kind of closer to their breakout highs, whereas the metals now are, significantly off their breakout highs, more recent breakouts, not the original breakouts. But there does seem to be a little shift of interest just even this week, within the context of what you just said. That's a good observation.
Well, Newmont Mining popped 13% today. I think that's because they're the only gold miner in the S&P 500. So you have these generalist fund managers, as you said earlier in the interview, they're starting to put, okay, we need 1% allocation to gold and gold mining. Okay, we're just going to buy Newmont since they're in the S&P 500.
Yeah, and we said last week, Newmont's poised to pop. It's poised to catch up. And there you go. It's exactly why. That's exactly what we're talking about.
I want to ask you about uranium, because the uranium price last 12 to 18 months, I mean, there's been a clear breakout. There's fundamental reasons. A lot of the policymakers in the U.S., European Union, the United Kingdom, they're starting to talk about approving nuclear power plants again, investing in them. Do you think that we're in a nuclear power and uranium bull market now?
Absolutely. When you look at the projects that are planned, the projects that are already underway, I mean, it's a lot. You're talking about 300. One of the reports I read about 3 months ago was talking 300 projects planned globally. France was the most recent one to kind of acquiesce to more. I mean, yeah, uranium is a bull market. And you want to talk about something that is, linked back to Russia. I mean, Russia is the largest refiner, the enricher of uranium out there. We get a lot of our uranium in the U.S. from Canada too, but the degree to which Kazakhstan and Russia are key to these markets is also a wild card factor that I think makes this a potentially very explosive situation. You kind of had your first wave higher. I think it takes more of a degree of understanding about, you say nuke and people just want nothing to do with it right away. And I think when they get a better understanding of how this is the wave of the future, whether you like it or not, whether it's safe or not, it doesn't matter, in the sense that this is the way we're going, because it is the least expensive, most efficient alternative energy to petroleum. It's that simple. So yeah, I think it's hugely bullish. And I think that it is still kind of, hit with this connotation that is not so positive, that is holding it back. I think that you have some issue with getting some of these approvals actually pushed through. There's still, a lot of resistance to this. But at the end of the day, going forward, the supply-demand fundamentals in uranium are pretty wildly bullish.
And I agree. It's the most efficient, cheapest form of baseload electricity.
By far beyond solar and wind. And I mean, it's just really kind of insane. And so, yeah.
Well, I think what people are learning the hard way since the pandemic started in 2020 is that if you support solar and wind, like the ESG crowd, your electricity bill could go up $1,000 a month. So that's a big no-no. I mean, if you're a small business owner, that's potentially, you're in a lot of trouble.
Well, these people that have these ideals and that they're so, I mean, I almost feel like people want to be in conflict these days. And I think that's part of the science too, by the way. It has to do with brain chemistry and some of the polarization that's actually taking place inside of people. You see it. You see that human beings are acting in increasingly volatile ways. that has a lot to do with the vibrations of the human heart versus the vibrations of the crust of the planet. We're out of touch. We're out of sync. All of this has kind of gotten misaligned recently with some of the increases in the frequencies. We're under attack from all this light in the place we are in the Milky Way right now, and it's affecting the energy on the planet. So, when you talk about these things like the green, clean movement, I mean, you get people that just want something to protest, and they want to get out there, and they want to, be enraged and be, confrontational, and oh my God, and you're bad, and this is bad, and oh my God. And it's like they believe everything they hear in a 5-second, diatribe. They might hear something and they're going to believe it 100%. And they're going to, they're going to die with this belief 100% all in. And it just kind of blows my mind that people are so willing to not be more educated, not do research. Who reads anymore? Who reads science journals? I mean, besides me. I mean, I'm Saturday morning, I'm all over science journals all the time. I'm all over medical. I always want to know more, and always reading the sources of research and experiments and the things they're finding out. So it's all a big science thing to me. But a lot of people hear something, they want to pick up a cause, they go to bat for it, and they really don't even know what they're talking about. And so to me, this is a bigger problem going forward. When you have such a short attention span, everyone sees what they see on social media. That's their source of information. They're going to believe what they say. The powers that be believe if they say something, it must be true, right? I mean, it's like, hey, okay, let's say this. And if we say it, we can make it true. And it just kind of blows my mind with the degree of, excuse the way I say this, but the degree of ignorance out there about so many of these topics that, are going to lead to acquiescing to a higher level of general inflation.
Well, I think the problem that a lot of politicians and a lot of people that are saying that they're in favor of solar and wind don't understand is you can't have all these technologies, data centers, electric vehicles, artificial intelligence, which requires all these data centers, not just like a software program on your phone with ChatGPT. You have to have all these data centers and electricity usage. Mark Zuckerberg just did a podcast talking about this, talking about that they don't have enough cheap electricity. So you need the copper, you need the cheap electricity, you need stable baseload power for all these new technologies, companies, investments for electric vehicles. And we don't have that. They did not make the efficient infrastructure investments into these things.
This is the way to do it. Rush out, try and change everything. But, as we've spoken about offline, I mean, what I don't think people really fully understand, and in my mind, there's really not evidence to support this other than anecdotal evidence, what's right in front of you. And that this whole movement has nothing to do about like changing the climate. You can't change the climate, okay? That's ludicrous concept to begin with, okay? The degree to which we have an influence on this is so minimal compared to the bigger picture science, it's not even funny. But the extent to which, this is all about not changing the environment, it's about an engine of global growth, something we can create more debt to spend money on, to support the economy, to create jobs, because you always need an engine of global growth. We can go back to the 80s when we saw it was like the Asian tigers at one point, then technology through the 90s with the internet and price discovery, and then you created this huge 20-year trend of disinflation to deflation, and the price discovery dynamic, which has kind of gone away as well now too, where people are now more concerned about securing supply than securing the lowest price. I think that was a big shift that came out of the pandemic that was secular, that a lot of people don't talk about psychologically. And so this is more about, we need an engine of global growth, particularly in Europe and places where they have this high debt too. The US, of course, is involved, where they need the growth or a debt deflation becomes a higher risk, and that this is all a smokescreen to borrow more money and spend it on these things to try and stimulate the economies. I think this is much more about economic growth and the need for some engine of economic growth than it is about changing the planet, because I think the officialdom understands you're not going to change the planet. You're not going to change the climate. This is a solar/Milky Way dynamic that is only going to intensify for the next several hundred years. So to think that we're going to have an impact on changing that in the next 30 years is ludicrous.
And there's also not a country like a China where we can outsource all of our factory and manufacturing and reduce labor costs and manufacturing costs by 70, 80, 90%.
Yeah, that's right. You've lost that as well. You're right on. So again, what does that mean? It means wages higher, acquiescing to higher rates of general inflation. You don't have that labor depressing dynamic out of China, in terms of wages. So,
then I think we're back to a lot of policy mistakes from the 1920s and 1930s, post-World War II. with financial repression, yield curve control in the 1970s, stagflation, because you're starting to see politicians talk about they want to protect jobs in their domestic economy with tariffs and raise wages there. They don't want foreign people buying as many foreign goods. You're talking about currency wars, global currency debasement, kind of a lot of similar mistakes from past financial history.
Stagflation is the wave of the future. It really is. I think that's going to be the next big trend. And that's going to be something that the Fed's going to have to deal with. And I mean, not to be a broken record, but it comes back to the same thing: acquiescing to higher rates of inflation to make sure that the growth doesn't collapse and that doesn't drive us into a debt deflation. Because that's the worst case scenario right now. And central bankers will go to any lengths to avoid that from happening. And that means printing more money. And it's the same story: debasement of the purchasing power of paper currencies.
But you think they're trying to manage that, though, right? So they're trying to keep inflation kind of in a range so most people don't notice. The real inflation rate is above the bond yields on the government debts. And then the DC, the US Treasury, the Federal Reserve Bank, they don't really want a strong dollar, or do you think they're trying to manage the dollar on the exchange rate?
Yeah, I think they're trying to manage it. I think that they understand that a strong dollar becomes a problem in a variety of ways. First of all, the impact on emerging markets, which we're already seeing. So I'm watching the EEM. If you want to talk about stock market and what the impact could be on the stock market, you can take a clue from the EEM, which is the emerging market ETF, which has not at all kept pace with any of this rally in the developed nations, all right, especially the U.S. And there's levels there where if you start to break down, that could be really serious. The CEW is the emerging market currency ETF. You're keeping an eye on that too. Where it is now, looks like it's a toppy about to break down here too. So I think there are big risks to allowing the dollar to go higher. But I think that I really can't shake the feeling that the Fed would like to see as kind of the last straw, all right, to their policy objective, some disinflation in equities. I mean, how are you supposed to see the Fed shift to cutting rates when the stock market's at record highs and gold's above $2,000 an ounce? Where's the motivation for the Fed to cut rates in that scenario? Why? Because the labor market might roll over, or because people are upset? I mean, it's like kind of, what are you talking about? I mean, so I think that for this to be real for the Fed, and this is where it's the most dangerous game, trying to tweak it to let a little bit of air out of the bubble without the bubble deflating, is such a dangerous game. But I think that's kind of where we're at right now. I can't shake that feeling every time I kind of hear the Fed talk. I look at what the markets are doing, and I just feel like this isn't over for the Fed, where they feel victory, where they can feel they can claim victory over inflation until they see some disinflation in asset prices.
Well, I think we're the Fed is trapped again through policy mistakes with DC spending, and then also the Federal Reserve Bank policy itself. The green spend Fed was promoting the wealth effect, and then correspondingly, the tax receipts became more and more dependent here in DC on home prices and stock market capital gains taxes. So over the last 3 decades, I think it's now reliant. I think 30% of the annual tax receipts are from home sales and stock market trading capital gains taxes, whereas a couple decades ago it was only around 10%. So now you're in a situation here where if asset prices fall for a prolonged period of time, especially home prices and stocks, where the government tax receipts start to collapse.
And that's true. I think that they would probably look at it like, look, if asset prices did fall, then the Fed could unload and that would bring them right back up. So, yes, I agree with all that. But I think the issue is more around kind of being able to declare victory and then being able to unload and get the stock market back up. So I see some kind of, I wouldn't say a crash. I don't think the market's going to crash, but I could see some kind of sharp correction where you get a bout of liquidation. Let's not even forget the fact that a lot of the moves here in these markets, you want to talk about AI. I mean, it's all well and good for some of these chip makers and everything. But, you need this to be applicable to consumer products that are going to create profits for companies selling this stuff. You're so far away from that this AI is great in the short term, and I get it. But at the same time, when you look at something like NVIDIA versus the NASDAQ, it's a straight line to the upside. So this has had an impact, but a limited one. Now, where now you see even the XLK, the Infotech ETF, is breaking down. It's breaking down on its own. It's breaking down on a relative basis. So when you kind of apply all this back to the stock market, I could see a kind of a fast and furious corrective move that allows the Fed to kind of declare victory. They cut rates, everything comes back, and then the stock market starts to rally again, but doesn't keep pace with the inflationary push in a lot of these underlying commodities.
Yep. And then the Fed probably has to start buying commercial real estate, office buildings, mortgage-backed securities. They might even have to buy municipal debt if the states get funding crises. I mean, the Fed will just change the rules at this point. Post 2008 with the bank, the types of bailouts and the rules changes they've done, nothing would surprise me at this point.
Another whole level of complacency. We talk about all the complacency, whether it's the Middle East, whether it's the political situation. I mean, the commercial real estate thing was a big deal. We talked about this towards the middle of last year, understanding what was coming. And, it's been shrugged off already. So watching the banking statistics too. I mean, I still think there's a lot of banks that have issues. I mean, the banks have underperformed. The community banks are breaking down again, a second time here now. And on a relative basis, and on the QABA, which is the ETF for those two, a lot of the individual names that came up in the CRE, when you're talking about office space or you're talking about multifamily buildings, I mean all of it. So again, here's another level of complacency with something that's been swept under the rug that is almost forgotten about, that is still a very real risk that the Fed will have to deal with at some point.
Yeah, I agree. I mean, they've been doing a bunch of like kind of extended pretend games for a lot of the commercial real estate loans for the last 12 to 18 months. But the regional banks, Greg, their loan books are a minefield. A lot of these regional banks hold an enormous amount of older bonds, and then they have like tons of consumer debt that's bad on like auto loans, credit card debt, small business loans, commercial real estate. I mean, I wouldn't want to touch these things a couple of years from now.
Which is why they're saying they're going to be tightening standards on auto loans and credit cards for the next year. So, I mean, you want to talk about this, you expect a stronger consumer too. It affects the consumer in the back end of all of that, because you're 100% right. This is the small banks, and the banks that have less than 10 billion in assets hold 1/3, 35% of the commercial real estate debt out there. I mean, that's crazy. And when you start to look at those banks, they're breaking again right now. So, yeah, I think that's a real near-term thing that could extrapolate, like you say, out towards the consumer as well, and how the Fed's going to deal with that. And let's not even, forget, hey, QE, buying treasury bonds, probably back in play at some point in time. It's going to be. It has to be. They have too much debt to sell. It's just insane when you talk about the interest costs, when you talk about borrowing from the public, when you talk the means of financing is borrowing from the public. I mean, it's kind of nutty. And I think that QE is almost inevitable again. And that goes right back to everything we've been saying throughout this interview.
I view QE as just old-fashioned debt monetization and bailouts. So, I mean, they called it another name. I don't know if they'll call it quantitative easing going forward, but it's from financial history. It's just debt monetization.
Well, Jason, what's funny about this is I wrote this in the book in 2006. I said the Fed will print, money, and I talked about monetary Armageddon, which is you reach the point where there's so much debt and there's so much risk from a debt deflation that you have monetary Armageddon, which is the Fed governor and the Treasury Secretary are in the monetary bunker. They have the keys. They're putting them in to turn the nukes, and they basically print enough money to buy every Treasury bond ever printed. All right, that's where we're going. Ultimately, that is kind of a scenario that is not so outrageous. And when I wrote the book on gold in 2006, and I said the Fed, we're in a commercial, we're facing a real estate thing that's going to affect the consumer in a really negative way. That's going to cause the Fed to buy bonds and start monetizing government debt. And I did a book tour, and I was on Squawk Box on CNBC, and I was interviewed with Joe Kernan and actually Mark Haynes at the time. And they asked me about that I had written that in the book. And, I talked about it, and I said, gold was trading around $400 at the time. I said, this will be big for gold. I'm not a gold book, but understand the Fed will have to work the dollar down. They will buy treasury bonds and print more money, and gold will skyrocket. And I did finish the interview, and I walked off, and they go to the green room to grab my stuff, and they have a TV in the green room. And Joe Kernan was calling me a nut job on national television, right? And I couldn't believe it. I'm like, he's like, oh, these nut jobs. He thinks the Fed will never buy bonds, and that's just outrageous to think. Well, and so it happens, in 2008, 2009. And what's interesting, I was back for an interview in 2010. All right. And this is a story I tell sometimes. And I'm in the bathroom, literally at the urinal. And who walks in? Joe Kernan. And he's standing next to me. Well, I'm 6'10". I weigh almost 300 pounds. I used to be a basketball player. And, I rarely use my size. I'm a gentle giant, right? But in this case, like, this guy called me a nut job on national television. And all I remember is like leaning over a little bit, like standing at the urinal. There's only two urinals. He's right next to me. And just trying to make him feel small, And what was funny about it is, And I looked at him, I go, you don't remember me, do you, Joe? And he looks at me and goes, no. I go, you called me a nut job on TV in 2007. And he just looked at me with this blank look of fear on his face. And I swear to God, I am not kidding. I'm not exaggerating. I'm not, embellishing. By the time we left the men's room, he was inviting me to play golf at his freaking country club. So, the point of the story is don't ever think something is not possible in this day and age, let alone back then, especially now. They will do whatever they have to do to avoid a debt deflation. And in this case, it gets back to everything we've been saying for the last hour. All right. Acquiescing to higher levels of general inflation and further debasing the purchasing power of paper currencies, not just in the US, but everywhere on the planet.
And I call it stagflate tax lie, but there's like rules changes and bailouts. I mean, let me add to your points there. We know this because Jeff Gundlach disclosed this. He hired someone from the Federal Reserve Bank to add to his bond fund team recently from DoubleLine. And he was telling a story about this at a grants conference on an interview on a speech he gave. It's on YouTube. And he said that the person at the Fed, they were discussing in 2020, like rules changes about not only buying municipal bond debt and corporate bonds. And then they said, we have to get our lawyers and the lobbyists to get the rules changed first. And they're like, oh, no problem. We'll just get the rules changed so then we could buy all the corporate debt and the municipal bonds. So this is like the mentality of the people in power, the unelected bureaucrats, the board of governors at the Fed. But it's the same attitude for most of the people in Washington, D.C. now.
Well, it's almost the offshoot of the MMT, this modern monetary theory or whatever it was that, you could just, it really didn't cause any, there was no negatives to doing this kind of thing, right? And it's like, well, okay, but because we haven't had inflation in 20 years doesn't mean we can't now, especially when you talk about the sheer numbers, the levels, the parabolic nature of the math. It's just tipping point stuff. It really is. But that is really interesting to me. And I talk about this all the time, too. When you talk about the municipal debt, when you talk about the state's debt, come on. It's also out of control. And again, another level of complacency. But if that is the solution to buy the debt and monetize it, what does that mean you probably should own to keep pace with that kind of dynamic? It means you need to own commodities and hard assets.
Yep, you need inflation hedges. So you need inflation hedges. You don't want to be holding the currency for a long period of time. You want to go find assets that will have a chance to keep pace or beat inflation.
You know what? It comes down to what you just mentioned, James Grant, the great James Grant, one of the best in the business. He's an instant first ballot Hall of Famer in our industry. I used to write for his website. In fact, I know Jim quite well. He's brilliant, and it's like he's been saying this stuff for a long time, and people didn't listen until it started happening, and then you got to listen. And in that case, it kind of comes down to what he used to have was the pyramid of assets. And it just comes down to one simple saying that I use now in the newsletter quite a lot, just even recently. Stuff over paper. It's almost that simple right now. And I think that that's a real kind of rallying cry for investment going forward in the future.
Yeah, even China, I don't know if you've seen the numbers, but China's been importing copper, stockpiling it at a insanely high pace in just the last couple of months. And people are like wondering, like, why are they stockpiling this much copper? And I was like, well, if they have trade surpluses, they might want to just rather build a new warehouse and stuff it full of copper, which won't go to zero, than buy more U.S. treasuries.
Absolutely. Diversified out of the dollar. They're hoarding commodities. They own 54% of the world's wheat that's above ground. I don't know how long wheat necessarily lasts and how you can control that. But the degree to which they are hoarding commodities and they are liquidating. China is doing the Jim Grant play, buying stuff and selling paper. That's the play. And guess what? I've been doing this a long time. I remember when I first started on the floor, the phone that was kind of connected to China wasn't really that important. It was really the OPEC phone, the London phone. We even had the ARB with Chicago in the silver market. That's how antiquated it was when I started. But the Chinese phone probably now is the most important phone. And what I did learn over time is that the Chinese have always been very astute traders. You could say, I don't know how much you know about Xi. Here's a lot of history with Xi. He's a Maoist. He's a manifest destiny guy. This is why Vietnam is in play. The Philippines are in play. Korea is in play. You want to see a currency that's gotten wasted lately? It's the Korean won. All of a sudden, under the guise of this whole thing going on in Gaza with Israel, Xi is sending one of his top guys to meet with the leader of North Korea, and they signed a strategic alignment pact. Hello? Do we know where Korea is? South Korea? It's right across the strait there. You want ships coming into Shanghai and stuff, you got to go right past Korea. You got to go right past Taiwan. You got to go right through the Philippines, right past Vietnam. All these places are at risk. So when you talk about China, I would say, and I take no pleasure in saying this, U.S. all the way. Right now, China is outplaying us every step of the way. So, of course, they're hoarding these commodities. They've been brilliant traders for history, right? Traders going all the way back to the silk trade, for example. So the context of them buying commodities, hoarding them on the, when, and you see it too, when commodities come down, that's when the Chinese are there. And that's when the big import numbers start to show up. So this applies to a lot of these commodities, and they're really playing, they're outplaying us. They're playing above the rim, and they're outplaying us right now.
That's a good basketball analogy there. Yeah, they're getting a lot of second chance rebounds. They were buying a lot. they were buying a lot of gold and silver months ago when no one else was buying it. Everyone's like, well, why are they buying gold and silver?
Huge amounts. I actually did a special report on that. And any of your listeners want to get it, they can feel free to email me. But yeah, this was a major report breaking down all the statistics. China has been the primary buyer of gold over the last 12 months, by far. It has not been U.S. It has not been retail. It has not been ETFs. It has not even been coins. The coin demand has been down significantly, just over the most recent, rally in prices has affected demand in the U.S. in the coin market. So yeah, the statistics are pretty clear. China has been accumulating gold along with copper, like you say, and a lot of these commodities, all the way down to some of the important food commodities.
Well, Greg, you are truly a wealth of information. I definitely want to have you back on in a couple of months. I want to thank you so much for your time today. If my listeners want to follow your work, take a look at your newsletter, how did they do so?
The best way is to just get some samples is to just shoot me an email, sales@Weldon Online, WELDON online, one word, weldononline.com. And I'll shoot you out some samples of the research that we provide. And of course, we also manage money for accredited investors. We're a high minimum because these markets require high minimum, not because we want a lot of money under management, but because for me to apply, I worked with Louis Bacon, one of the greatest hedge fund managers, one of the greatest traders in the world, up there with Tudor Jones. They're like distant cousins or something. There's a whole family dynamic between the Bacons and the Joneses that goes way back. It also ties into some of the other large hedge funds like Tiger, right? They all kind of know each other to whatever extent, and they come from the same place. But the extent to which really risk reward math and really applying very stringent risk controls. You can trade commodities without taking ridiculous amounts of risk. It just takes capital to allow the math to work to where I can apply my risk regiment to allow me to take the losses that I need to take to be involved in the wins that I need to be involved in. And our goal is to, outperform, pretty much everything out there. It's still some degree of looking for higher returns while taking a little more risk than maybe you might see in some of the, equity market or some of the, the big houses and some of the, programs they want to sell you and all the dynamics around trying to, increase their money under management. It's important for us that we are capitalized enough to be able to handle the risk and the swings here, to be able to succeed in helping people keep pace with the debasement of the purchasing power of their paper money. It is that simple, and that's what we do here, and we've done it quite successfully over time. And although, of course, I must say, past performance does not guarantee future results. In this day and age, you can't guarantee anything.
Yeah, exactly. There's tons of rules changes. I mean, oil futures contracts went briefly negative. Who would have seen that? That was crazy.
Seriously.
I mean, at this point, with the oil futures going negative, I mean, I wouldn't be shocked to see gold prices at $3,000 in the next 12 months. There could be a lot of stuff happening. I mean, there's rumors of a plaza accord if the emerging market currencies continue to get weak against the dollar. There's been some rumors floating around that too, which would, be good for commodities prices, especially gold, if there was a one-time dollar devaluation.
I think, Jason, to be honest with you, I think I started that rumor. I really do, because I've been talking about that recently in the past maybe 4, 5, 6 weeks. I've been sharing my experience in the Plaza Accord. I was active in 1985 when the Plaza Accord was struck. I remember vividly that day waking up in my apartment, going to the train station, and all the world's abuzz. You didn't have the accessibility and information back then that you have now. You had what they called the Quotrex machine, which was like this giant handheld thing that you could punch in and get numbers and see markets and get some news headlines. And I'll never forget, there was buzz on the New Jersey Transit to the PATH train to the Trade Center that day about the Plaza Accord and what it meant. And it was one of the wildest days ever. I was on the Florida Commodities Exchange on that day. And so I've started talking about that recently. So it's so funny to me that you just brought that up, because I have heard no one else talk about that until just now, outside of myself, for the last 4 or 5 weeks.
Well, try to be ahead of the curve. I mean, I was warning about the
Always.
Chinese demand spike in gold and silver months ago, and people were like, well, it's not going to affect the dollar. I was like, well, if they're going to take delivery and clean, like the custodians of the GLD and the SLV are going to get cleaned out, it's going to happen eventually. The price is going to move.
They're going to play the dollar card. I mean, there'll come a time, this is when everything changes. And, when they say, look, we're the biggest importer, over $300 billion of stuff every month. We're the biggest exporter, over $300 billion of stuff every month, by a 3-2 margin over the U.S. When they say we're only going to accept renminbi for our exports and pay renminbi for our imports, the dollar is done. And that is a day that is going to come. I don't know how long that's going to take. I don't know how we get there, but it's a trend towards that. And that will be a day of reckoning. If you want to use another great in our industry, Bill Bonner, I mean, the day of reckoning. That is what comes when China plays the dollar card and they hold the weapons here. You want to say it's like this is already a resource and financial resource war that's going on. And you want to think that the U.S. holds the best weapons here? We don't. China does. All right. We're the ones with all the debt. China's the ones that really doesn't care about the stock market. As long as their people are employed, they don't really care as much about the economy. It's a manifest destiny dynamic. And in that case, when they want to move on Taiwan, they hold the dollar card over the U.S. You don't let us get away with this. We play the dollar card, and you're in depression in the U.S. It's a really fine line right now, and there's so much risk out there that I don't think that people fully are cognizant of or aware of, or even understand how devastating it could be. That's the biggest one in my mind right there. I've been saying this for a while. There's a lot of complications around that thought process, but that doesn't mean it can't happen.
Well, also the people in DC, they don't understand things and they do dumb policy mistakes all the time. Look, they weaponized the dollar and froze 300 billion of Russia's reserve assets. And they thought, oh, we got Russia. We're going to get Putin. We're going to get Russia. Yeah. Well, the other non-G7 countries, the central banks decided, well, what happens if we piss DC off? Now we're going to start buying more gold tonnage each month. So it backfired. It was like a Looney Tunes Yosemite Sam. They just straight up shot themselves in the foot. The policy mistakes were that bad.
It's exactly why the Chinese have been buying gold. So look at what they just did to Russia. Well, we're not going to let them do that to us. It's 100% right.
Well, unfortunately, I'm here in the DC metro area with a lot of people who are 2 or 3 degrees, and they think they're geniuses, but their real world track record, Greg, are not as good as you trading commodities futures. Their real world track record is full of blunders, but some way, somehow, they managed to keep growing their net worth, like Janet Yellen.
Yeah, I'm not even going to go there.
or Ben Bernanke getting like $20 million for consulting work from a hedge fund.
Hey, I'm just glad that I love what I do. Otherwise, I wouldn't be able to work these 16, 17-hour days with the passion that I do. And it's sometimes, at this point in my career, it's not even so much more about, oh, we need more clients, we need more money under management, we need more money, more. It really is now almost become a mission to try and help people to more, to at least try and even the playing field, number one, and then at least try to keep pace with what governments are doing to the purchasing power currencies. I mean, it really is, it's pretty disgusting when you really look at it from the top down.